I interviewed Professor Jeremy Siegel of the Wharton School yesterday in overtime. You know what? His view matches up with some of the more sunny outlooks for the remainder of this year, in large part because of what he thinks the Fed is going to do and, frankly, what it isn't. Here's Jeremy Siegel.
I think they should do another 100 basis points by the end of the year. You know, I mean, the market expects a bit more, but that does fulfill a good tightening. I don't think they need to go higher than that. And, you know, scaring the market saying we're going to stay high through 2023 when they have no idea what's going to be happening in 2023, I think it was really not a good image to project.
All right, so that's Professor Jeremy Siegel. So, Farmer Jim, I mean, he largely is in your camp. And I said to him, OK, so if that is the result, if you're right and it's 100 basis points more and that's it, what does that mean for stocks? And he said something to the effect of overwhelmingly good. Now, yes, the flip side of that is what UBS is talking about today, even as they maintain their own view of 100 basis points for the remainder of the year. Further volatility caused by earnings revisions, downgrades, and higher than expected default rates over the course of next year. That's a very plausible view for both outcomes. What does that mean then for stocks?
What I think is, and I'm going to try to riff off of what Josh said, because I think he said it very elegantly and very balanced. There are many potential scenarios going forward. OK, and anyone who says, slamming the table, that this is the scenario that is going to happen. Hang on.
But we need to deal in probabilities. That's what all of you do.
Perfectly
the
fine.
way that
Perfectly
you
fine.
invest and the way that you design your own market outlooks. The higher probability right now is that I could see, OK, Fed goes 100 more, 50, 25, and 25. A high probability of that. There's also a high probability that earnings revisions are going to happen, and they're going to come down. It's only to the degree that they do. I think that is a high probability on both.
OK. So
I think one can agree with that.
Well, no.
Where?
No. So, but just
where? Just tell me where.
OK. All right.
Just tell me where.
Just don't start yelling at me, OK? When I disagree with you, you tend to yell, and I don't like it.
Just tell me where. I'm not yelling at anybody.
It matters your perspective, OK? What I do is I talk to company managements. I listen to earnings calls.
Okay.
I go out and do my own gumshoe detective work. And what I'm telling you, just simply, is that aggregate demand, all right, has not fallen off the cliff, that everybody who says earnings are ready to just calamitously fall.
I didn't say calamitously fall. I said there are going to be downward revisions.
Let me phrase it
almost a formality at this point. You suggest that earnings are not going to be revised lower at all.
Well, they might be revised lower. No, we're talking about probabilities. I don't think there's any need for derision as we disagree, Scott, okay? I don't think it is a fait accompli that the earnings are coming down. And again, based on my perspective, I note, by the way, and just give me a little rope on this, okay? I note that 3 months ago, we were having this discussion, and there was a concept of the analysts are out of their minds. They're delusional. It's a word that's been used a lot over the last.
I used that word many times in describing why they hadn't taken down their estimates to that point.
And maybe you're right. Hang on one second, Jenny. Maybe you are right. I'm dancing with you on this. You may well be right. I see the probabilities as not quite as high as you do. And this is coming from the perspective of listening to company managers. It doesn't matter whether it's Cisco Systems, Wynn Resorts, I mean, Hewlett-Packard Enterprises. You know, this is my perspective. Other people have different perspectives. I don't see the rapid drop in earnings that I think the bear case is predicated on.